Look, I need you to imagine something for me. You've got $5,000 sitting in a savings account, earning basically nothing, maybe 4% if you're lucky. And you keep telling yourself you're going to invest it. You're going to build that dividend income stream everyone talks about. But here's what happens. You open your brokerage app, you see that dividend stocks are paying 3, maybe 4% annually, and you think, that's $200 a year on $5,000. That's not even worth my time. So you close the app and tell yourself you'll invest when you have more money. Sound familiar? My name is Oric, and I spend way too much time thinking about dividend investing and compound growth. If you're someone who knows they should be investing but keeps putting it off because the initial returns seem too small to matter, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Here's the thing that nobody tells you about dividend investing. Everyone focuses on the yield, right? They see 4% and they do the math and they get discouraged. But what they completely miss is the acceleration factor. And I'm going to show you how $100 a month, combined with a strategy that most people completely overlook, can turn into genuine wealth faster than you think possible. Now, before we get into the actual strategy, I need to address the psychology here, because this is where most people completely sabotage themselves. There's this study from Vanguard that analyzed investor behavior over a 20-year period, and they found that the average investor underperformed the market by about 1.5% annually, not because they picked bad stocks, but because they started and stopped. They got discouraged early when returns were small, and they gave up before compound growth could actually work. And I get it. When you invest your first $1,000 and you're making $40 a year in dividends, it feels pointless. You can make $40 in an hour at most jobs. But here's what most people don't realize. You're not investing for today's income. You're investing for tomorrow's acceleration. Let me show you what I mean with actual numbers. Let's say you start with nothing, literally zero, and you commit to investing $100 every single month into dividend-paying stocks with an average yield of 4%. Most people look at that and think, okay, $100 a month for a year is $1,200 times 4% is $48 in annual dividends. 48 bucks, who cares? But watch what happens when you add one simple rule. You reinvest every single dividend. This is the part where it gets really interesting. Year 1, you're right, you make about $48 in dividends. Reinvested, that's an extra $4 a month you're adding, barely noticeable. Year 2, you've got about $2,600 working for you, generating around $104 in dividends. Still doesn't feel like much, right? But here's where the math starts to shift. By year 5, you're not just getting dividends on your $100 monthly contributions. You're getting dividends on 5 years of contributions, plus dividends on all the previous dividends you reinvested. You've got roughly $6,600 invested, generating about $264 annually. That's $22 a month in passive income. And here's the key. You didn't have to add anything extra. You just kept doing the same thing you were doing. Now you might be thinking, Oric, $22 a month still isn't life-changing money. And you're right. But stay with me because this is where most people quit right before the acceleration actually kicks in. By year 10, something magical happens. You've contributed $12,000 of your own money at $100 a month, but your portfolio isn't worth $12,000. It's worth approximately $15,000 to $16,000, depending on dividend growth, and it's generating around $600 to $640 in annual dividends. That's $50 a month. Still not quit your job money, but look at what just happened. Your dividends alone are now covering half of your monthly contribution. This is the acceleration I'm talking about. You're still putting in $100, but the investment is doing half the work for you. By year 15, this is where it gets absolutely wild. You've personally contributed $18,000, but your portfolio is worth somewhere around $27,000 to $29,000, and it's spinning off roughly $1,100 in annual dividends. That's $91 a month. Your dividends are now almost entirely covering your monthly investment. You've essentially built a machine that funds itself. And by year 20, You've put in $24,000 of your own money over 2 decades. Your portfolio is worth approximately $45,000 to $48,000, and it's generating between $1,800 and $1,920 annually. That's $150 to $160 a month. Your dividends are now exceeding your contributions. The machine isn't just funding itself anymore, it's actually starting to grow faster than you can feed it. But here's what most people don't realize, and this is the psychological shift that changes everything. At this point, if you stopped contributing entirely, this portfolio would still grow. In fact, just from dividend reinvestment alone, this $45,000 portfolio growing at 4% dividends would be worth roughly $68,000 in 10 more years without you adding a single dollar. Let me put this in perspective. You spent 20 years building the foundation with $100 a month. If you just let it sit for 10 more years, it grows by an additional $23,000 without any effort from you. That's the power of the acceleration phase. The first 20 years, you're building the engine. The next 10 years, the engine runs itself. Now, I know what some of you are thinking, but Auric, 4% isn't very exciting. I could get better returns in growth stocks or index funds. And look, you might be right about total returns, but here's the thing about dividend investing that makes it psychologically different than other strategies. You can see the progress. When you invest in a growth stock, your only feedback is the stock price going up or down, which is affected by market sentiment, economic news, things completely outside your control. It's abstract. But with dividend investing, every quarter, real money hits your account. You can see it, you can track it, you can watch it grow. And there's something about that tangible progress that keeps people consistent in a way that other strategies don't. There's actually research on this from behavioral economics. A study published in the Journal of Financial Planning found that investors who received regular dividend payments were significantly more likely to stick with their investment strategy during market downturns compared to investors in non-dividend paying stocks. Why? Because they were still getting paid. Even when the stock price was down, the dividends kept coming. That psychological reinforcement is huge. But here's where the real $100 dividend acceleration strategy comes in, and this is what separates people who build real wealth from people who just dabble. Once your monthly dividends hit $100, you enter what I call the doubling phase. Here's how it works. Let's say you're at year 15. Your dividends are $91 a month. You keep contributing your $100, but now you make a commitment. The moment your monthly dividends hit $100, you increase your monthly contribution by $100. So now you're putting in $200 total, your original $100 plus the $100 dividend match. When your dividends hit $200 a month, you increase your contribution to $300 a month. You're essentially always doubling your dividend income with your own contributions. This creates an exponential curve that most people never experience because they never commit to the acceleration. Let me show you what this looks like with the doubling phase starting. If you start the doubling phase around year 15 when dividends hit $100 and you keep doubling as dividends grow, by year 25, you're not looking at a $45,000 portfolio anymore. You're looking at something closer to $90,000 to $100,000, generating $3,600 to $4,000 annually. That's $330 to $330 in passive income. Now, I need to be real with you about something. Not everyone can increase their contributions like this. Maybe you can't afford to double your investment every time dividends hit a certain threshold, and that's completely fine. The core strategy still works with just the $100 a month. But if you're in a position where you're getting raises at work, where your income is increasing over time, this doubling strategy is how you turn a modest dividend portfolio into something that actually changes your financial life. Here's what most people don't realize about this whole strategy. It's not really about the money. I mean, it is, but it's not. It's about building the identity of an investor. See, when you commit to $100 a month for years, even when it feels like it's not doing anything, you're rewiring your brain. You're becoming the type of person who invests, who thinks long-term, who doesn't need instant gratification. And that identity shift is worth more than the portfolio itself, because once you see yourself as an investor, you start making different decisions across your entire financial life. You start thinking about purchases differently. You start valuing assets over liabilities. You start seeing opportunities that other people miss.
There's this concept in psychology called identity-based habits that James Clear talks about in Atomic Habits. The idea is that the most sustainable changes come not from setting goals, but from deciding who you want to become and then proving it to yourself with small wins. Every month you invest that $100, you're casting a vote for the identity of investor, and eventually that becomes who you are. So here's the actual action plan. If you want to implement the $100 dividend acceleration strategy, here's what you do. First, set up automatic monthly transfers of $100 from your checking account to your brokerage account. Make it automatic so you don't have to think about it. Second, choose a diversified group of dividend-paying stocks or a dividend-focused ETF. I'm not going to tell you what to buy because I'm not a financial advisor, but look for companies with a history of consistent dividend payments and dividend growth. Third, set your brokerage account to automatically reinvest all dividends. Most brokerages have this as a simple checkbox option. And fourth, don't check your portfolio every day. Seriously, check it quarterly when dividends are paid,